I follow a lot of contributors on Seeking Alpha and I read a lot of articles. Nicholas Ward is one of the better contributors that I personally follow here on Seeking Alpha, and I've been following him for over 7 years. Before contributing on Seeking Alpha, Nicholas was actually contributing on SureDividend.com. SureDividend.com, the website is not very flashy, but the content, the articles that they create have been around for years. And when I was first learning about dividend investing, this was one of the sources that I went to first. You know, Ben Reynolds and Nick Ward, they were really inspirational for me when I was looking to build a dividend portfolio that I was one day going to live off of. Now, there's a lot of things that I agree with in this article from Nick, and there's a few things that I disagree with, and I think context matters, and I'm going to walk you through this article, share my thoughts and opinions. And if you're maybe new to this is a new series that I created on the channel. I create YouTube videos here on Sunday and now on Thursdays where I review articles like this every single week. So if you're new, welcome to the channel. So Nick starts off by saying that the summary of this article is that retirement strategies are not one size fits all due to individual variables like nest egg size, lifestyle costs, and goals. Conventional retirement plans like real estate investing and the 4% rule have pros and cons influencing personal retirement strategies. My retirement plan prioritizes passive income generation, dividend growth, and active portfolio management to avoid forced asset sales or ensure financial freedom. Nick is absolutely a stock picker. He is very, very much active in managing his portfolio. So this is not going to be applicable for a lot of people who want to have this a little bit more passive. So Nick is very, very much hands-on when it comes to picking and managing his portfolio. And Nick Ward is a financial analyst, and he is a contributor on the Dividend Kings here on Seeking Alpha. So let's take a look at it. I'm not quite ready to retire yet, but one of the most common questions that I get from readers is, well, if you were, how would you do it? I had some free time this week, so I decided to put together this report which highlights which strategy I would use, while also touching upon several other popular paths that retirees take and why I'm avoiding them. Enjoy. So there are many ways to skin this cat. I'll be the first to say that there are many different ways to invest capital to achieve a comfortable retirement. Yet none of these strategies are a one-size-fits-all option for investors because of the myriad of variables that are at play when it comes to meeting each individual's needs in retirement. Everyone's nest egg is a different size, everyone's lifestyle cost is different, everyone's goals and dreams for retirement are different. And lastly, everyone has different ideas about what they want their financial legacy to be after their time on earth is through. Therefore, when thinking about retirement, it's extremely important to be thoughtful about your options and to pick a path that suits the resources you have available to you alongside your projected spending levels, because what's a comfortable retirement boils down to is being able to live below your means once you stop receiving paychecks. With all this in mind, I want to be clear, this piece is not financial advice. I don't know your financial situation, nor do I want to. That's the job of a professional advisor, and that's not me. All I'm providing here is my thoughts on retirement and my eventual plans to transition from my personal portfolio from the accumulation phase to the distribution phase in an effort to meet my family's needs. But before I talk about my plans, I want to highlight several of the conventional plans and strategies that I've researched and have ultimately decided not to pursue, and why. Because these strategies have proven successful for millions of retirees over the years, and although I don't plan on pursuing them directly, they have influenced my thinking on the subject, and I think it's a good idea to discuss their pros and cons before we arrive at the ultimate destination, my plan. So the first one, being a landlord. I'll start with investing in physical real estate, either commercial or residential, as income properties. This is a great way to build wealth and generate passive income via rent checks, but there are two primary issues here. One, to maximize real estate investing, you have to be willing to leverage a lot of debt in your favor, and I don't feel comfortable with that. I used to work in real estate. I've seen former partners make a lot of money and frankly build real estate empires by buying properties, fixing them up, renting them out, refinancing them with an elevated valuation attached due to the renovations, and starting the process all over again. Using this strategy is possible to, it's like the Burr strategy, using this strategy, it's possible to essentially own properties for free while technically the bank owns them, but that's not the point. Most real estate investors that I know don't care about the value of their portfolios, and all they care about is the cash flow they throw off. But I don't think I could sleep well at night knowing that I had dozens of mortgages, cash flow or not, and I certainly don't consider the income from rental properties as passive. That is absolutely correct. Even if you use a property manager, real estate is not passive. You have to follow up and manage your property. You have to manage your asset, as Ben Mala always says, if you follow him here on YouTube. Real estate is absolutely not passive. Moving on here, a lot of work goes into managing a real estate empire, even if you're not doing it yourself. There are headaches and costs, and recently I'm seeing more and more laws passed in favor of renters as opposed to landlords in disputes. Another thing that scares the hell out of me is the squatter's rights. He must live in a blue state or a blue city where the renters completely control the situation. In Texas, where I owned real estate, the landlord had most of the rights. It's just the way that the leases work. But if you're in like New York or in certain areas of the country or in the world, I believe Canada's the same. And he might actually even be Canadian, if I'm not mistaken. The laws are skewing much more towards renters. And I don't have a dog in this fight. I think, we want to take care of renters. There's a lot of bad actors, a lot of bad landlords, but not by default. Not every landlord is the boogeyman. Not every landlord is bad. So it's kind of a heated topic, a heated debate, but you don't want to paint it with a broad brush because it really just depends on where you're at in the situation. But he's absolutely right. Depending on where you live, it can be not very advantageous to be a landlord in certain areas in the world. Moving on, adverse possessions would also keep me up at night if I allocated the majority of my money towards real estate investments, and therefore this isn't a strategy that fits well with me and my family. A comfortable retirement is all about sleeping well at night after all. So once again, this article is about if he had to retire, which path would he choose? And real estate investing is absolutely works for some people, but he is saying he's going to pass. So moving on to the next one, various approaches to the 4% rule. So according to Prudential, the 4% rule limits annual withdrawals from your retirement account to 4% of the total balance in your first year of retirement. That means if you retire with $1 million saved, you'll take out about $40,000. According to that rule, this amount is safe enough that you won't risk running out of money during a 30-year retirement. I've read numerous studies that show that the extremely high inflation-adjusted success rate of the 4% rule, the famous Trinity study, is what gave birth and credence to this strategy, and it's worth looking into if you're someone who is thinking about managing money through retirement. So the 4% rule in the FIRE movement is really based off of the Trinity study and the research that went into backtesting portfolios and success and failure rates of living off of a portfolio. And so with the 4% rule, essentially to summarize, you're statistically, it's overwhelmingly in your favor to retire off of the 4% rule. If you have a 30-year time horizon, it's very unlikely that you will die before your portfolio goes to zero. And that's the traditional 4% rule. In general, these studies assume that investors are allocating at least 50% of their portfolio towards equities, and their growth alongside stable bond income should generate total returns that outpace the proposed withdrawal rate plus inflation. Using Monte Carlo simulation, studies have shown success rates ranging from 86% with a 4% withdrawal rate all the way up to 98% with a 3% withdrawal rate when thinking about not running out of money throughout a 30-year retirement. If you're able to live comfortably with a 2% withdrawal rate, then the simulations show that you're all but guaranteed to not run out of money in retirement. And depending on the stock picks, there's a high likelihood that you'll see your nest egg will continue to grow in spite of annual withdrawals. Now, he threw in here stock picks. He's kind of he's, in the words of a boglehead, he's perverting the idea of the 4% rule because it's not taking into account living off of individual stocks. It's talking about the index, from my understanding. So moving on, over the years, there have been several major schools of thought that developed with this in mind. Unfortunately, none of them mesh well with my long-term goals. Once again, Nick is a stock picker. More on that in a moment, but first let's quickly highlight a few popular plans that the 4% rule believers follow. So the Boglehead approach: own VTI and chill, basically own everything and benefit from the greatest capitalistic minds across the world. It's a solid, diversified, equity-driven strategy. So you're just owning everything, the total U.S. stock market and the total U.S. stock market, not the total world stock market. And then next, the 60-40 approach: 60% stocks, 40% bonds, is a tried and true retirement strategy meant to shield conservative investors from equity downside via bond holdings, which oftentimes have an inverse relationship to equities. We didn't see that in 2022, by the way. That was kind of scary. This strategy has worked for millions of retirees over the years, and the numbers always point towards long-term success, especially within the 4% rule confines. So the next one here is the SAHD and chill approach. Basically the same as VTI and chill, but more yield-focused. SAHD or other dividend-centric ETFs have rules regarding the stocks they can own that usually revolves around dividend yields, dividend growth streaks. Personally, I prefer VIG to SAHD. However, SAHD offers a notably higher yield. That's a benefit relative to VTI as well. SAHD yields 3.7% right now, and VTI yields 1.3%. That nearly 4% yield matches up well with the 4% rule because it means that SAHD and chill practitioners would hardly have to sell any shares to generate the annual withdrawals they'd need. Very, very true. Good point. A more secular, that's living off of your portfolio with dividend investing, not having to sell your shares. So absolutely. A more secular growth-centric approach. I know some people look at SHD holdings and get upset because by owning that index, you miss out on a lot of the best secular growth stories. Think the Magnificent Seven stocks, which are notably absent from this portfolio. I've seen a lot of posts regarding portfolios that are centered around ETFs like QQQ, or even more specific high growth areas of the market, such as semiconductors or cybersecurity stocks. These offer more growth while sacrificing passive income, which means selling more shares to meet withdrawal targets. The idea here is that the growth will more than make up for the shares sold over the long term. This is the retiree's dilemma. How do you do it? Do you do it just all or nothing with individual stocks, with ETFs? Do you just do growth? Do you just do income? Do you do a combination? That is why there's so many opinions, because there's so many different paths and you have to find what works for you. And yeah, the thing here is like with this SHD and the dilemma that he talks about here, well, you don't get enough growth. That's why I talk about the simple path to wealth with dividend investing, which was inspired by G.L. Collins. You combine SHD with a growth ETF like DGRO, which is similar to VIG, which he's talking about here in this article. By combining them, you're capturing more of the market, you're capturing more growth, and you can allocate to your portfolio higher or lower into DGRO depending on your time horizon. That's how it works, guys. There's many paths that lead to success, but that's just how it was for me. But anyway, so his plan here, but if you're someone like me and you don't want to have to ever sell anything, I'm a control freak. I never want to find myself in a situation where forces outside of my control force me to do anything. The way I see it, I haven't worked hard for a decade plus to build a sizable investment portfolio only to sell it off in retirement. I know there's a die with $0 approach that some people feel comfortable with. I don't. Heck, if I did, I could probably retire today, but I want to leave a lasting financial legacy for my children and or charitable organizations when my life is over. Creating generational wealth. High five, Nick. The issue that I have with so many of the 4% rule portfolios is that they require regular asset sales, and my retirement strategy is built around never touching my principal or only touching it if I want to. Selling assets at the top of a bull markets always feels great, but selling assets during bear markets or worse, recessions, is going to feel terrible. And in the event of a prolonged bear market, being a forced seller could negatively impact the mass surrounding financial independence. To me, that's not financial freedom in the first place. Being forced to return to work is not an ideal situation for retirees because of things like ageism or large resume gaps. In short, I never want to be forced to sell assets down 20%. Plus, I don't want to have to return to the force the workforce. Once I decided to leave it, I want to sleep well at night with the confidence that I will never run out of money. And with disciplined, active portfolio management, I believe that is achievable. Now, this active portfolio management, it will require active portfolio management if you're a stock picker, if you only have individual stocks, which we'll get to in a second. So that's something to very, very much be aware of, that this will still be active if you only have individual stocks. Moving on, to me, true financial freedom is a situation where I can generate passive income that exceeds my expected lifestyle's expenses by a large margin. My goal is to retire when I can comfortably generate 120% of my expected annual expenses. I like that he quantifies this. Most people don't quantify it. So if you're thinking about retirement and you're thinking about fat fire or regular fire or anything in between, I like that he has an actual percentage. And I think that's a smart way of looking at this. This margin of safety will provide peace of mind and the knowledge that I will be able to pass down the income generating machine that I built to my kids, so that future generations of Wards, his family, will be able to experience the same financial freedom that I have. It will enable me to continue to reinvest into attractive opportunities throughout retirement. Lastly, it will give my family the ability to meet large unexpected expenses and to splurge on things if and when we really want to. Obviously, that goal requires a certain amount of capital to begin with. Everyone's financial freedom number will be different, but here's the portfolio that I've constructed that is meant to get me to the number as quickly as possible without violating my risk tolerances. So this is his current portfolio. So you have to remember, the title of the article is "If I Had to Retire Today." Now, don't get confused, because this is where I have a little bit of critique with the article. It can be confusing. The article is if you had to retire today, and now he's giving examples of what he's invested into today. So it's not really answering the title of the article. So just kind of stick with me here. So his current portfolio is set up of individual stocks. He's got Apple, Nvidia, Broadcom, Microsoft, and you can see here, if you're watching, I got it highlighted in red. He's got 9% in Apple, 7.5% in Nvidia, and over 6% in Broadcom. Those are not ideal for, if you follow my channel, you know that I do not like it when you have more than 5% in a single stock. It doesn't matter if you were right and then you hit it big. That's not what it's about. It's about, protecting your portfolio and keeping emotions out of it. So that's why I have it marked red here. You can see here that he has his portfolio, and you can pause the video here if you want. You can see here that he's got like the Visas in here. He's got RTX, Salesforce, Qualcomm, and he has it structured like his own ETF. His current portfolio is just like an ETF. And I have it marked here. Now, I'm sure that he'll adjust the allocation here as he gets closer to retirement. But just as an example, let's assume that this was his portfolio that he retired on tomorrow. Let's say he had $1 million in his portfolio and he has less than 1% allocated, for example, to Prologis. So if he had $1 million and he had less than 0.33% allocated to Prologis, that means he's only, with $1 million portfolio, he's got $3,000 invested into one stock. Is he really a shareholder of Prologis? And then if you assume that Prologis has like a 3% dividend yield, that means he's getting less than $100 a year with this position. And in my opinion, if you're only getting $100 a year in a single stock and you're retiring with that portfolio, I don't think that you really, I just don't see the point. Okay. And that's just my personal opinion. I just don't see the point to have so many holdings, so many positions, and have such a low allocation to it. And like, if you were to do that, on a quarterly basis, he's going to get what, like $25 a quarter? I don't know. So I'm a little bit critical of this approach. I used to be very honest and candid. I used to do it like this because I followed kind of the path of Nick and other people that kind of, when I first learned about this, years ago, I built my portfolio like this. And then I realized how inefficient it was for me personally, because he stresses, once again, he's a control freak. He wants to actively manage it. I didn't want to do that. I didn't want to actively manage this in early retirement. So you kind of got to figure out, and when you read these articles, you got to understand, is this something that you realistically want to do, or is this a little bit overkill? And I would say for the majority of people watching it's probably going to be overkill. But for the select few who are maybe engineers and really want to optimize this, this is a cool way to look at this, right? So to each their own, you got to find what works out for you. Moving on, the direction I'll likely head in during retirement. Currently those holdings, so his current portfolio yields about 2%. Ideally, I would like to retire with a 2% withdrawal rate. I thought he said above that he didn't want to sell anything. I guess he said he'd be open. That's kind of contradicts itself a little bit, but I can imagine a world where impatience pushes the target up to 3% or so, but I don't plan on going much higher than that because doing so would require me to sacrifice too much growth. In a nutshell, there's an inverse relationship between yields on assets and their growth potential, capital appreciation upside. Growth is immensely important for me when I'm thinking about early retirement because God willing, I'll have to generate income that at the very least keeps up with inflation over the long term. Throughout retirement, I'd like to generate a passive income stream that posts 5% annual growth so that I have a nice buffer when it comes to potential periods of prolonged inflation. I think this is kind of weird that he's saying 5%. Like with that type of portfolio, and this is his current portfolio, it's not going to be what he retires on, but it sounds like he's going to have a much higher dividend growth rate. But yeah, well, I mean, I don't know. So anyways, to be clear, if I was 70 years old, this wouldn't be the case, but I'm 34 years old and I hope to retire sooner than later, meaning that I need to plan for decades on inflation eroding away the purchasing power of my passive income stream. Therefore, dividend growth will be paramount to my retirement strategy. But since my 2% yield does not equate to 100% of my annual spending target, I'm not ready to retire quite yet. People still ask me all the time, how would I do it? They wonder when I'm ready to make the jump from asset accumulation, saving and investing, to the distribution phase when I leave the active workforce, stop reinvesting my passive income, and allow it to pay my bills. What sort of portfolio do I plan to build? Well, that's a fun exercise I'll highlight today. In this piece, I'll focus on the classic 4% yield. If this essay is well received, I'll work on a subsequent how I would retire reports that focus on different withdrawal rates, rate targets like a 3%, 5% yield thresholds to start. Okay, so my 4% yield target retirement portfolio. So this is the portfolio from the article, right? Everything that we just read before was kind of where he's at. This is the title of the article. If I had to retire today, this is how I do it. My 4% yield target retirement portfolio. So with all of that being said, here's the 4% yielding portfolio that I would build if I had enough money to comfortably retire with a 4% withdrawal rate, and 2, if I were forced to retire today. So the company, okay, so these are the companies here. I'm not going to read every data point, but essentially you can pause the video if you want to see the individual tickers that he outlines here. So what he's doing is he's highlighting a portfolio of companies that are, checked for quality, growth, and yield. And he's targeting a 4% current yield with a 7.5% dividend growth rate. Okay, so that is a good mix. A 4% starting yield and a 7.5% dividend growth rate. I like that. So earlier, a few minutes ago when he said a 5+%, I thought 5% was actually pretty low. That's why I kind of was confused. It made me pause for a second. So a 7.5% is much more I think is much more feasible for what he's trying to accomplish here. So he doesn't have them weighted in any way. It's just his strategy. If he was forced to retire today, this is the premise of the article. He would look to have, and this obviously it depends on your time horizon. If somebody is, 25 or early 30s, they're probably going to want to have a little bit more growth. If somebody's in their late 50s or 60s, that's why an article like this is so difficult, because it really, really depends on your time horizon. But for him, if he were to do it, he would have a 4% dividend yield and a 7.5% dividend growth rate weighted across his portfolio. So I hope that makes sense. If you just read the article, it's maybe not quite as clear, or if you're not used to reading articles like this, you may have overlook that, but that's the gist of what he's saying here. So moving on, overall here, I prioritize dividend yield, safety, growth prospects, typically in that order. The average yield of the portfolio is 4%. It was above 4% before yesterday's big rally. As you can see at the bottom of the chart, the yield includes a handful of low yielding, high growth stocks that provide exposure to long-term secular growth trends. To me, no portfolio should be without exposure to the best trends in the technology sector, and this portfolio is no different. Admittedly, the quality here isn't as high overall as I'd like it to be. None of the companies that I include in this model portfolio are bad per se. However, many of them lack the compounding potential that I typically like to see. Well, then why did you include them? Okay. I consider each of the holdings listed above to be blue chips within their industries. However, I wouldn't be satisfied with this portfolio because it lacks exposure to too many of my favorite long-term investments. Okay. I'm also working on a report right now titled The 20 Best Stocks in the World. Okay. Ideally, the 20 holdings in my retirement portfolio would be the 20 highest quality stocks that would lead to the most peaceful rest, alas, when prioritizing yield. That's not possible. I kind of find it weird. Like, I like the article, but like, it's like, why do you even recommend that or say that? But then like, give a disclaimer like it's not the best. Every article that I read always does this. I don't know why. If you're gonna list a list of companies and stocks, like list them or don't list them. It's just like, here's the list, but they're not perfect. And I'm just like, well, what was the point of writing the article if they? Oh my gosh. Oh man, it's. Moving on, I'm also working on a report. Okay, so we just read that. Cool. He's working on a report. Anyways, even though I had to sacrifice compounding growth to reach that 4% threshold, and overall, I like where the portfolio ended up as far as combination and quality of the yield goes. Ultimately, my personal portfolio in retirement won't mirror this one because I plan to have a lower withdrawal rate and therefore would require... Dude... What? The title of the article is, if you had to retire today, how would you do it? You show how you would do it, and then you're like, but I actually wouldn't do that. It's like, come on, man. Nick, I hope you watch this video, and by me reading this out loud, you realize how stupid that sounds. Why write the article if you're going to say something, and then right underneath it say, yeah, but I actually wouldn't do this? It's like, well, why did you even write the article? There's a lot of good stuff in here, but there's also a lot of what? Okay, let me back it up here. Okay. Ultimately, my personal portfolio in retirement won't mirror this one, even though that's the title of the article, because I plan to have a lower withdrawal rate and therefore would require a lower dividend yield. Okay, that's fine. Then why didn't you do that before? I also won't limit myself to 20 equally weighted holdings. Well, then why didn't you do it in the article? Okay, that decision was made for simplicity when it came to building out this model portfolio for simplicity. Okay, we didn't read the article for simplicity. We read the article because we want your expertise and we wanted your recommendation on how you would do it today. Man, I almost want to end the article now and just be like, WTF, man. I'm gonna go troll him in the comments. What the WTF, Nick? Maybe I'm being too critical. I don't know. I'd like to be much more diversified. However, I would plan on maintaining an extremely overweight allocation to equities like I have in this one because of the simple fact that bond yields don't grow organically. As I said in the strategy guide above, dividend growth is going to be paramount to my long-term success as an early retiree. Bond yields are great, but they don't grow. And while I understand that equities are a risk asset, and their yields are never 100% guaranteed, I also feel very strongly about the dividend safety metrics surrounding each of these holdings and do not expect to see any of them cut their dividends in the near term. Obviously, staying on top of those metrics would be important moving forward, but that's a part of a regular portfolio maintenance as a self-directed investor. Absolutely, this is very much an actively managed approach. So not really that passive, actually. I mean, it's not overly complicated. You can streamline this, but you definitely are going to have to keep an eye on your portfolio. With regard to maintenance and active monitoring, I will note that if this were my retirement portfolio, I'd watch it closely and trade in and out of the positions if and when valuations rose above fair value, assuming this means that I could rotate into higher yielding peers. For instance, I choose Coca-Cola for this portfolio because that's my favorite stock in the food and beverage space right now. However, I admit that names like Pepsi and Hershey's are basically interchangeable. I could say the same thing about McDonald's over a competitor like Starbucks or Alphabet or over a high growth tech peer like Meta. I could also see myself rotating into and out of certain sectors, depending on where the market sentiment went. Once again, very, very much an active approach. As I've said for years, I'm always happy to take what the market gives me in terms of value. Right now, this portfolio is overweight real estate and utilities, but that's because I believe these interest rate sensitive areas of the market currently offer investors some of the best value. If these sectors got hot, causing valuations to rise, I'd be happy to lock in profits and rotate to blue chips in other unloved areas of the market. Over time, it would be my goal to use value-driven active management to consistently increase the size of my passive income stream without diminishing the overall quality of the holdings. I'm interested to hear critiques of this model portfolio and see what others would or do own to support themselves in retirement. As the years go by and the value of my holdings increase, transitioning from the accumulation phase to the distribution phase will shift from a theoretical exercise like this to my reality. So I'm happy to soak in as much information as I can on the process between now and then. So that's the article here. So let's first take a look at some of the comments. So one here, concentrate to accumulate. Looks like you spend a lot of time thinking about your 25th, 30th, and 40th best idea. Looks a bit scattergun to me. Go for 15 positions max. Why not go 5 index ETFs and 10 extremely strictly screened stocks for return on invested capital of 20%, et cetera, et cetera. So when you have a portfolio of just individual stocks and you kind of market cap, you weight them kind of like an index fund. And I kind of mentioned that earlier. You're only having a small percentage in some individual stocks. And it's like, if you're only investing a couple $1,000s in them, is it really worth the hassle and the stress and the time of actively managing them? And in my opinion, no. And so I generally agree with a comment like this. But if you don't have any exposure to any index funds, then I can kind of understand that. You want to go a little bit wider. And so I can see that. Another comment here, I think he's running an ETF. Look at Charlie Munger's portfolio. 4 or 5 stocks. Warren says, buy what you know and manage it. You can't do that with 60 stocks. I have 19 stocks and 3 ETFs. I watch them every day. I do the work and have done remarkably well the last 10 years. Yeah, my strategy has been somewhat simply over the years, but the best companies that I can find at any given point in that are also trading with an attractive margin of safety and then hold. I don't sell stocks when they become overvalued. So long as their fundamentals and dividends continue to grow, that more than, okay, so that's why I was confused. Like he said in the article that, he would trim them if they got overvalued. So he's got to have a methodology in terms of, how he decides when to sell a stock, right? So overall, I give the article a B plus. I give the article a B plus. There's a couple of things that I like. I like that he highlights the different strategies that you could retire off of. Because remember, the article is, if you had to retire today, how would you do it? And he takes a look at the main approaches to retire. Being a landlord, investing in the total US stock market and living off the 4% rule, investing into SHD and chill. And his approach is to actively manage his portfolio of individual stocks. And the part where he answers this question of how he would do it is he would have a combination of stocks that yield around 4% and have a dividend growth rate of 7+%. Now, he kind of rambles a little bit, kind of getting to that point. The article could have been 1/3 this length, and if he just would have answered the question instead of explaining everything out. That's why it gets a B+ for me. But yeah, I think most people who look at this approach, I don't think that most people would benefit from an approach like this. I personally like following Nick and other creators or contributors like Nick who talk about investing in individual stocks because I like looking at it as a form of inspiration for my satellite positions. I subscribe to the idea of the core and satellite approach, where the overwhelming majority, my core portfolio, is made up of index funds, ETFs. That, for me, is true sleep well at night. I would not sleep well at night if I knew that I had hundreds of thousands of dollars in just a handful of stocks. And if something were to change out of the blue, think about it for a second. A blue chip stock is a blue chip stock until it's no longer a blue chip stock. Do you understand that? I understood that when MPW cut its dividend. I understood that when Kraft Heinz cut its dividend. I understood that when X, Y, and Z cut its dividend. And I understood for me that I don't want to have that stress in retirement where the next black swan event happens, because for whatever reason, in today's world, a lot of black swans happen. A lot of, oh, this never happened before, happens a hell of a lot nowadays. It feels like I say all the time, this has never happened before. Well, it sure seems like this never happened before is happening a lot more often than it has in the past. That's just my impression. Let me give you a random example. A stock is great until it's no longer great. Think about, the criticism that CrowdStrike and Microsoft are getting. What happened with CrowdStrike? In the last month, CrowdStrike is down like 30%. No one, not the management, nobody, no investor, no insider foresaw this coming. Or maybe they did. Maybe there's a conspiracy. I don't know. But what my point here is, a stock is great until it's no longer great. And unless you want to reactively or try to proactively time when you're going to get it in and out of a stock because all your portfolio is individual stocks, that's not sleep well at night for me. And I wish that years ago, someone would have shown me a video like I make where I talk about the simple path to wealth with dividend investing, where my core, using the core and satellite approach, where my core portfolio is made up of index funds that meet my goals and my situation, and I combine them with satellite positions where I can get more growth or more yield. I wish I would have read an article or watched a video like that 7-10 years ago. Because 7 or 10 years ago, I only read articles from people like Nick, where they were only talking. I like Nick, by the way. I'm not trying to bash him. People like Nick who were stock pickers, and I wish that I would have got exposure to other ideas and ways of looking at this. Now, I'm intentionally showing Nick's article here to you, even though I talk about something entirely different. It's important that you see both sides of this. And that's why I talked about in my last video last week, why the bogleheads hate dividend investing, right? It's so important that you learn how to think and not what to think. So with that, everybody, I hope that this video helped teach you how to think and not what to think about if you had to retire today, how you could do it. Thanks everybody for watching. As always, I'll see everybody next week on Thursday, and I'll see everybody here this Sunday. And I hope you all have a great week. Thanks for watching.